Hello, welcome to week 7. This week we're talking about savings and capital formation. So before we go into that, let's take a look at history right for a second. Big crash, right? The Great Depression. During most of 1929, stock prices have been rising steadily, right? Investors were feeling rich and they were feeling safe, right? People were spending money and they're putting money into investments and savings into banks. However, that fall, a famous economist, Irving Fisher, remarked, stock prices have reached what looks like a permanent high plateau. Unfortunately, Fisher could not have been more wrong. Right, shortly after Fisher's optimistic prediction, stock prices in the United States started falling fast. Right, and they bottomed out in July of 1932. Right, this was at a level 90% below the high that happened in September of 1929, just 3 years earlier. Millions of Americans lost their investments. Worse yet, the stock market crash was followed by a devastating drop in output, employment, and prices in the United States, as well as around the world, and this was known as the Great Depression. People alive during the Great Depression of the 1930s have shared stories of breadlines and having to make do with very little. Right? Novelist John Steinbeck wrote, people with muscles aching to work, right? Minds aching to create, but jobs were hard to find. The Great Depression started in 1929, and the worst part of it lasted through 1933, 4 years later. Right? But it took over a decade for the economy to actually recover to pre-depression levels. In contrast, right, the Great Recession of 2007 to 2009, right, the housing collapse of 2008 was another sharp global economic downturn, right? It was far shorter and far less severe than what happened in the 1930s. However, right, millions of Americans still lost their jobs, right, and unemployment reached 10%, right? By 2014, many indicators, though, had returned to pre-recession levels. Now, depressions and recessions are puzzling, right? People are willing to work at the prevailing wage, but they can't find a job. Firms can supply output, but there simply isn't enough demand. Workers lose their jobs, machines run idle, inventories accumulate, and output falls sharply. People suffer, right? And it's no wonder that economists want to know what went wrong, right? How did this happen? More importantly, right, they want to know what policymakers can do, right, to get an economy back on track as quickly as possible. In most economic models, right, prices rise or fall to keep the markets in equilibrium. When prices adjust like that, there should be no food shortages, no unemployment, and nothing resembling the Great Depression. The standard models were useful, right, for understanding standard cases, but they couldn't explain something as extraordinary as the Great Depression. However, in the 1930s, there was a British economist named John Maynard Keynes, right, introducing price frictions into a model of the economy. Keynes' model showed that rather than really adjusting, right, prices were actually sticky and rarely decreased enough during recessions to restore demand. Right, that idea was revolutionary, and it placed the focus on what we call aggregate demand. Right, macroeconomists, right, have now extended many of Keynes' original insights and theories, right, and his basic ideas help to continue explaining economic booms and busts in the United States and abroad. Now, I mentioned aggregate expenditure. Now, when economists face downturns, right, in both spending and production falling, right, and to understand that, we need to start with the components of aggregate expenditure. Now, if you remember, measuring the GDP, right, show that all activity in the economy can be summarized by gross domestic product, or GDP. And one way of calculating GDP is by aggregating all expenditure in the economy. Right? Aggregate expenditure, or Y in most cases when you see it, or Y sub D, can be divided into 4 primary components of spending, right? One being consumption spending, one being investment, government spending, and net exports, or exports minus imports. Now, this tells us, right, that everything that was produced must have been produced by a combination of households, C, firms, I, the government, G, and foreigners. And next, the net exports, right? This equation is just an accounting identity, really. Right? It doesn't depend on assumptions about the behavior of decision makers, and it can actually tell us a lot about how the economy works. Right? To get further in, we need to understand how the key parts of this work. So the first one being C, consumption. Right? This is the starting point. Consumption makes up 2/3 to 3/4 of GDP in most countries. Because it accounts for such a large share, right, consumption accounts for much of the variation in aggregate economic activity. Right? And you make economic consumption choices every day, right? And you probably understand the basics of consumption. You decide how much to spend on food, travel, entertainment, transportation, and housing. Right? You decide how much to save for later, or you choose how much not to consume now. Right? And oftentimes, right, there's 4 contributing factors: current income, current wealth, expected future income, and the interest rate on saving and borrowing. Right? These are basic factors of consumption expenditure. Now, current income, right? People who tend to earn more consume more. It's pretty simple, right? You make more, you spend more. For example, most investment bankers live in nicer houses and drive fancier cars than most teachers. Of course, the exact relationship between earnings and consumption depends on specific details, right? It matters whether your income will always be high, or if it's likely to fall in the future, and other such trends. So if you win the lottery this year, might be another example, right? You might save a big chunk of the winnings to spend later when your money goes back to normal. Alternatively, a young family may want to borrow to buy a house or car early on, especially if they expect their future income will grow over time. Now, these details matter a lot when considering particular households, right? They matter less when we think about the basic pattern of across all households, right? When we think about households in general, right, we can streamline things by assuming that households simply consume a constant fraction or portion of disposable income, right? That is income after taxes and transfers and depreciation, right? And this is actually called the MPC, or the marginal propensity to consume, right? So it's saying that, okay, if a household receives an extra $10,000, say, in disposable income, right, and the marginal propensity to consume is 60% or 0.6, right, then the household will consume $6,000 of the $10,000, or 60% of the disposable income, right, over the extra disposable income. Now, there's also this idea of wealth, right? Wealth takes many forms. Examples of wealth include money held in savings and checking accounts, holdings of stocks, bonds, mutual funds, the value of houses and other property. Right? From those assets are subtracted the amount of any debt owed on them, such as credit card debt, mortgages for home loans, student loans. Wealthier households tend to spend more, so we assume that increased wealth leads to increased consumption. Conversely, decreased wealth leads to lower consumption. Right? That should make sense. After all, higher wealth households can afford to consume more for any given level of income. Right? This is confirmed by evidence. When the level of saving rises in an economy, aggregate consumption tends to rise as well. Right? This occurs because households can dip into savings to fund consumption rather than being limited by their income. Indeed, changes in stock market and housing wealth have driven some of the most dramatic movements in consumption of the last 20 years. Often, policymakers want to know which households are likely to have a larger marginal propensity to consume, right? And as I said before, right, income and wealth matter. It is commonly assumed, for example, that poor households have a relatively high marginal propensity to consume, right? Or consume a larger portion of their income. Why? Because by definition, poor households often do not have enough income. As a result, they're likely to spend a relatively large portion of any income they receive, right? And recent research backs this idea, and it's finding this pattern, right? And actually, some wealthy households also act like they're poor. And we can consider this in what we call the hand-to-mouth. Now, there's also this idea of not just consumption, investment, and savings, but in wealth, but also future income, right? Expected future income. Now, most people try to keep their spending fairly even or steady, right? When the income rises and falls, right? And this is a desire to smooth consumption over time. As a result, future income tends to influence current consumption in much the same way that current income does. If you expect your income, specifically your future disposable income, to rise in the future, you tend to be more willing to borrow or to dip into your savings in order to fund a higher level of consumption today. Similarly, if you expect your income to be lower in the future, you tend to consume less now in order to save more for later. Right? There's a positive relationship between expected future incomes in the economy and current aggregate demand. There's also a component which we call the interest rate, right? The interest rate is what we call the price of money. For savers, right, it's the price received for letting the bank use your money for a specific period of time. For borrowers, though, it is the price of using money for a specific period of time. Thus, the interest rate determines, right, the financial return on savings and the cost of borrowing. Now, the interest rate, or what we call specifically the real interest rate, which is the interest rate adjusted for inflation, influences consumption. Right? A higher interest rate generally encourages savings, which in turn reduces or decreases consumption. In the same way, a high interest rate discourages people from borrowing on credit cards and taking other loans to pay for purchases. This also decreases consumption. Right? This is why we have so much information about the Fed increasing and decreasing interest rates, because of the effect it has on our aggregate consumption or aggregate demand. Right? There's actually a negative relationship between the interest rate and consumption. Again, so if there's an increase in current income, there's an increase in consumption. An increase in current wealth, increase in consumption. An increase in future expected income, increase in consumption. However, an increase in an interest rate decreases consumption.